What's up, everybody? Dan again, stocktrades.ca. Welcome back to the channel. It has been quite a while since I have posted a video, but I was in the process of finally moving into a new house build that I had been building for over the last year. So I finally have a set office. Prior to this, I was pretty much working out of my living room at a desk, but now I have a bit of structure, still getting a lot of stuff set up, but I should be able to put out a lot more videos with regularity. I plan to do one a week at minimum. So in this video, I am going to go over a very common question that I get, and a couple businesses that are in the same industry, you could say, but are very, very, very different in terms of overall structure, and that is Canada's alternative lenders. These two companies have exploded in price over the last while. I mean, I think we highlighted both of them over at Stocktrades Premium in 2018. I think one of them is up nearly 200% and the other one is up over 300%. These have been very, very successful companies, but a lot of people right now are worried about whether or not they are still viable in the current environment we're in. There's a lot of uncertainty when it comes to the economy, when it comes to consumer loans, when it comes to mortgages. So there is a lot of pressure on these stock prices. A lot of people are wondering if they're buys today or if you should be avoiding them until we get some, certainty when it comes to the economy, when it comes to when rates will be cut or if they'll be maintained, things like that. So let's turn to the screen and let's have a peek at two of Canada's top alternative lenders in Goeasy Ltd and Equitable Bank. So full disclaimer before we start the video, I own Equitable Bank. I know that's kind of going to be a spoiler in terms of what my favorite alternative lender here in Canada is, but I also do like Goeasy a lot. I just overall reduce my exposure to the financial sector and alternative lenders. I only own Equitable Bank, but in terms of the different business models, some people will prefer Goeasy over Equitable Bank, and some people will prefer EQB over Goeasy. It depends on the type of exposure you want to the financial sector, as these are two very different companies. I chose Equitable primarily because of the deposit-based business, the mortgage-based business, over something like Goeasy that primarily invests in consumer loans and even things like furniture. First, let's do a quick comparison of these two companies. So they're both mid-cap companies. Goeasy fluctuates between a mid-cap and a small cap. Equitable Bank, especially as of the Home Capital acquisition as of late, its book value has really jumped, and as a result, its market cap has shot into about over $2.5 billion. Now, at the time of filming this, both of these companies are overbought. They've had pretty big run-ups in price, primarily due to the fact that the rate hikes by the Bank of Canada, there supposedly is going to be a pause. That is far from guaranteed, but that is, at this time, what we're being told. It is not surprising to see both of these alternative lenders jump up on a pause by the Bank of Canada. They do have a higher risk client base overall just because a lot of their borrowers are denied by major banks and they head to a company like Equitable to get a mortgage or Goeasy to get a higher interest rate consumer loan. Now, Equitable Bank does score better on our Stocktrades growth score and our Stocktrades dividend score. 3.5 out of 5, 4.1 out of 5 compared to 3.2 out of 5 for Goeasy for the growth end and the dividend safety of 2.9. However, both of these dividends are relatively safe. Actually, they are rapidly growing as of late. And in terms of the growth end, Equitable Bank scores more on the growth end, primarily because it is trading at a significant valuation discount. If we look to trailing and forward price to earnings, we can see that Equitable is trading at only 7.7 times its trailing earnings. And when we look to a forward basis, this shrinks to about 6.5. Goeasy is at around 14 trailing and about 9.2 times forward. So Goeasy is the more expensive company, but I think the market is factoring in a much higher risk in terms of Equitable Bank, which I'm going to get into in a bit here. Price to earnings to growth, both of them are hovering around 0.5. So this just shows you that the market is not necessarily factoring in forward-looking growth for these companies. There's a lot of economic uncertainty. So the market is looking at analyst estimates and is predicting that these companies are not going to hit those estimates. That is why you see this PEG under 1. A PEG of over 1 typically means that the company has all of its forward-looking growth priced in already, where a PEG under 1 means that the market is not factoring in its expected earnings growth. So with these two alt lenders, it is very probable that these PEGs are sitting at this level because people, institutional investors, retail investors, they expect earnings estimate to be guided downwards, and as a result, these PEGs will get a bit closer to 1. Equitable is trading at 1.2 times book value. I'm going to speak on this a bit later in a more important segment of this video. Goeasy is around 2.7. And when we head down to profitability ratios, we can see that over the last 5 years, Goeasy has been the more efficient company. We see a 5-year average return on equity of 26.5 compared to Equitable Bank's 15.7. But the one key thing I want to show here is that Goeasy's 5-year average is 26.5, but their trailing 12-month return on equity is dipping a bit, whereas Equitable Bank has been able to maintain its return on equity over the last, trailing 12 months compared to its 5-year averages. And we can also see that Equitable Bank has much higher profit margins. You're looking at profit margins of 42% compared to around 16.5. Now, this is where both companies really shine, is the growth aspect. Equitable Bank has grown its earnings and revenue for 18 straight years. Almost 2 straight decades, this company has grown the top and bottom line. This is absolutely exceptional. There are very few companies in Canada that can maintain earnings and revenue growth streaks like this. Goeasy is not that far behind. It's got a revenue growth streak of 21 years and an earnings growth streak of 12 years. So that dates back to not around the financial crisis, but pretty much when the economy picked up post-financial crisis. That would probably be in 2010. But the one key thing to note here is that Equitable Bank, with a earnings growth streak of 18 years, this company grew the bottom line throughout the great financial crisis in 2008. We're looking at, 5-year average revenue growth of 16% with Equitable, 19% with Goeasy. You're looking at 15% 5-year earnings growth for Equitable, while Goeasy has just been an absolute beast with 46% earnings growth over the last half decade. Now, the one key thing here with both of these companies is Goeasy Limited's offerings, their financial products, their offerings, in the event of a recession, they will likely be impacted more than a company like Equitable Bank. And I'm going to get into why just a little bit later on in this video. We can see that when we look to growth estimates, revenue and earnings estimates for the next year, we can see that Equitable is expected to still grow the bottom line by around 9.3% next year. Now, this is highly likely due to the savings and deposit nature of their business, where Goeasy relies primarily on things like consumer loans, furniture financing, electronics financing, and this is going to slow down. There is no doubt about that. With rates being as high as it is, borrowing is becoming more expensive. So we can see that Equitable Bank is still expected to maintain growth next year, while Goeasy is expected to have a relatively flat year. When you consider the suite of product offerings by both these companies, it is really not that surprising. So in terms of the dividend, we can see that both of these companies yield, they're not necessarily the highest yielders. Goeasy's yield, just due to the overall market drawdown, is a little more attractive now than it ever has been. But both of them, they yield in the 2 to 3% range, and both of them have very low payout ratios. You're talking sub 30% in terms of earnings. Free cash flow, not necessarily a wise decision to focus on free cash flow with financial companies, primarily because they have negative cash flow due to the nature of the business. They're lending money out. But when we look to earnings payout ratios, there is still a lot of room for these companies to grow the dividend at a double-digit pace for the foreseeable future. Equitable, 12 years of straight dividend growth. Goeasy, 8 years of straight dividend growth. Now, Equitable Bank seems to be the company that makes small quarterly increases to the dividend. I mean, they're almost making a dividend increase every single quarter. They're much more conservative in their dividend growth. We can see 5-year growth of around 12%, whereas Goeasy has vaulted the dividend by nearly 40% over a 5-year period. This means they've essentially tripled their dividend since, what would it be, 2018 now. So we've looked at valuations, we've looked at the dividend, we've looked at expected growth rates. Now we'll go into the core functions of the businesses themselves. And by the end of this video, you're probably going to be able to distinguish why both of these companies are alternative lenders, but they operate in very, very different business models. Hey everybody, just a quick break from the video to remind you to smash that like button, head down below, subscribe to the channel. It helps us with the YouTube algorithm. More views we get, the more videos we can produce. And if you want a 14-day free trial to Stocktrades Premium, it's a full access trial, no credit card required. I will drop a link in the description. You can see all our stock picks, our screener and comparison tool, our Q&A. You can join our Discord. You can see our model portfolios, all that stuff. Absolutely no commitment required. It takes 2 seconds to sign up. But anyways, let's get back to the video. The one thing we can do to distinguish how different these businesses are is we can look at some KPIs for these companies. So if we look to Goeasy Ltd, we can see that interest income is a main driver of their business model. We can see that, in 2015, they had around $101 million in interest income. Trailing 12 months, this jumps to $662 million. So we're seeing a 6.6x increase just over the last, 6-7 years. This is because this company primarily functions on consumer loans. And you probably heard that I mentioned that they do furniture financing, electronic financing. That would be their easy home revenue right here. So this is not as fast of a growing segment as their consumer loans. So we can see here that, revenue is growing. 138 million in 2018. Trailing 12 months sits at around 151 million, but it is not growing nearly at the pace that interest income is. We can see a large scale increase in operating revenue from the Easy Financial segment, whereas the Easy Home segment makes up a very small portion of operating revenue. Now, this is not all that surprising because Goeasy's core business model is to provide consumer loans to people who might have gotten rejected by a big bank. So as a result, interest income is going to be this company's main driver of revenue. So it makes sense as to why this business was so popular during the midst of the pandemic and even over the last 12, 13 years because of the low interest rate environment. Money was very, very cheap to borrow. So consumers would either get rejected by a big bank or they wouldn't even go to a big bank. They would head to Goeasy regardless, take out a relatively cheap consumer loan compared to other options. Trust me, Goeasy's loans are still very, very expensive, but overall, it was cheaper to borrow in the past than it has been right now. And this is likely why this company is going to see a slowdown in growth moving forward until rates stabilize and start to come down. Now, when we compare this to a company like Equitable Bank, they are much more of a mortgage-based, deposit-based bank. Think things like savings accounts, high-interest savings accounts, TFSAs, reverse mortgages, things like that. Goeasy does not offer any of these products. So this is where the core differentiator is going to be between these two companies. And when we look to the KPIs, we can see that Equitable Bank is growing at an insane pace. We can see AUM in December of 2018 was around 29.4 billion. Trailing 12 months, we're sitting at $47.3 billion in AUM. Now, loans under management, again, it's growing at probably the same pace. We're sitting at 27.8 billion in 2018 compared to 43 now. But the one thing I wanted to highlight in terms of KPIs was Equitable Bank's customer base. So we can see that in December of 2019, this company had around 95,000 customers. We look to the last trailing 12 months, this company has 292,000 members. This is exceptional growth. And one of the main reasons why this company is able to grow this fast is simply because of its product offerings. This is not a brick and mortar bank. It doesn't have the overhead of a Royal Bank, a TD Bank. You can't go into an Equitable Bank. So as a result, it is able to offer much better interest rates on its savings accounts. It's able to offer cheaper mortgage rates. It's able to offer better options in terms of reverse mortgages. You're going to get more interest on your high interest savings accounts through Equitable Bank. It even has in recent times launched its Equitable Bank card. It's essentially a cash card that's going to not only pay you interest on the money in your account, but it's going to refund you any ATM fees and also give you cash back on particular purchases. These are the types of products that Canadian consumers will zero doubt switch from a major banking institution to Equitable Bank, especially as it begins to grow its reputation in Canada. And if we look to its most recent quarterly report, when it acquired Concentra Bank, it became the 7th largest independent bank in Canada by assets. This is no longer a small bank. Concentra Bank, I believe, was one of the largest credit unions in Canada. So it was a large-scale acquisition, and I would really expect that with this company's ability to deliver in the past, they are really going to integrate this asset into the company overall, and we are going to see this customer base continue to grow moving forward. We're going to see the company continue to push out better product offerings than the big banks, and as a result, people are going to shift from a major institution to a more convenient, better opportunity like Equitable. Now, the overall risks with Equitable Bank lie in its over-reliance on mortgages. We can see why this company's book value is discounted relative to the major banks. We can see right now it's trading at around 1.2 times book. This is primarily because of the acquisition of Home Capital. If we look to late November, this company was trading at 0.7 times book value. Now, when we consider the quality of this company's loan book, this was an absolutely crazy valuation, and the market was discounting Equitable Bank's loan book quality significantly. I ended up emailing investor relations probably 3-4 months ago and asked them how much of their loan book is insured, meaning pretty much how much of their mortgages have less than 20% down, and in the end they would be insured by a company like CMHC, Crown Corporation, that pretty much insures these companies' mortgages. This would be the mortgage insurance you pay when you don't have 20% down on your house. And they replied to me with 46%. Nearly half of this company's loan book was insured by pretty much a government organization. Yet the market was only willing to pay 0.7 times book value for this company. Now, when Home Capital was acquired, I believe they were acquired for about 1.1 times book value. This is where you can see Equitable really shoot up. And as of late, just because of a broader market recovery, this company is trading at around 1.2 times book value. But as we can see, the discount to Canada's premier banks is significant. And there is reasons for this. A company like Royal Bank, 1.9 times book value. A company like National Bank, 1.68. Toronto Dominion Bank, 1.67. These banks are going to trade at a higher book value, primarily because of their product diversity, the fact they have exposure outside of Canada, and just overall the quality of the loan book. Equitable Bank is very, very focused, as I mentioned, on mortgages and deposits. They don't have as diverse of a product suite as a company like Royal Bank. So we can probably never expect, unless this company, begins to expand further, diversify their product base more, that the market is going to pay this type of book value for the company. But we can also see it trading at near the book value of the Canadian banks that are not as diversified and maybe have started to post some very poor results as of late. As we can see, Bank of Nova Scotia and CIBC, it's trading relatively in line with those companies. And on the other end, when we think of the overall risk with Goeasy Ltd, it's pretty easy to judge what the major risks are going to be with this company, and it is going to be charge-offs and delinquent loans. If we look to the company's guidance for the next few years, it does expect charge-offs to actually not increase. And the one thing about this company is it has been very, very good at predicting these charge-off rates. Even in the midst of a global pandemic, this company was able to pretty accurately determine how many of its loans would be charged off. So the quality of this company's loan book is going to be in question moving forward, but really most all of the risks seem to be baked into the stock price already. I mean, this is a company that survived some pretty turbulent times. It was around during the dot-com crash. It was around during the great financial crisis. It was around during the rate hikes in 2017, 2018 when the market severely corrected. It was around during the COVID pandemic crash. So I would probably give this company the benefit of the doubt that if it says that its charge-off rates are going to be maintained, through 2023, 2024. They've hit that target before. I would expect them to do it again. And when we look to the other end of the guidance, the company is guiding to not as high of growth as it typically would put up, which is a sign of the times. Obviously, borrowing has gotten a lot more expensive, and this company is probably acknowledging the fact that it is not going to be able to grow as fast at 4.75% policy rates than it would be at 0.25% policy rates, which we saw just 10 months ago. But overall, we're seeing expected operating margins to be maintained and returns on equity, that are pretty much better than any major bank you're going to get here, and Equitable Bank at 22%. Overall, the way I would look at it between these two companies in terms of overall price action right now, I think that Equitable Bank is being discounted due to the risk of its mortgage book and the fact that it is more hyper concentrated on deposit type accounts and reverse mortgages, things like that. Whereas Goeasy is more priced for an economic slowdown. There's very likely going to be a decrease in activity with their Easy Financial segment, especially their Easy Home segment. I would expect a slowdown in that department. I would expect a slowdown in their overall loan origination. However, this is still a company that is very attractive in terms of price and in terms of their relative growth. In my opinion, the market has already discounted Equitable and Goeasy for the most part for future headwinds. So I know I've been talking for quite a while now, and you probably just want me to tell you right now which one I would buy. And obviously, I own Equitable Bank. I do view it as the stronger company in terms of forward growth. However, I would have absolutely no problem adding either of them. In terms of my overall portfolio, I pretty much run equal weight positions in Royal Bank, TD Bank, BMO, and Equitable Bank, along with a Intact Financial position. If I had lower exposure to the financial sector, I would be adding Goeasy Ltd. I would have no problems owning it just because I am maxed out in terms of overall financial exposure. It has nothing to do with the company. A lot of people don't own Goeasy Ltd. Primarily because they believe it operates a predatory business model, whereas Equitable Bank seems to be the more consumer-friendly, consumer-focused bank. This is completely up to you. You gotta have morals when investing. And if Goeasy is the type of company that rubs you the wrong way, that is completely acceptable. I have heard that actually more times than you would think from a multitude of our followers, our readers, our listeners. So do I think both these banks present some pretty strong opportunities? Absolutely. But we have to remember these are small cap, mid to small cap banks. They are nowhere near as secure as Canada's larger financial institutions, and I wouldn't be going crazy overweight on either of these banks. The one thing we need to understand is that these are alternative lenders. These are, small to mid cap companies. They do have much higher risk than Canada's big six banks. I wouldn't necessarily be replacing a position in the big six banks with these stocks, but I do believe they have a lot of growth potential moving forward, and I am very, very happy to own Equitable Bank right now. So everybody, that's pretty much it for the video. I am very happy to be back on the channel. I plan to produce a lot more videos. The more subscribes we get, the more likes we get, the more content we can push out. So remember, smash that like button, subscribe to the channel, and remember, there is a 14-day, no obligation, no commitment, full featured trial to Stocktrades Premium in the description below, and we'll see you next time.